If you were born in the 1940s, 1950s, or 1960s, federal tax legislation did update rules that could impact homeowners. However, lawmakers never created a nationwide property tax freeze linked to your birth year. Understanding this distinction matters greatly because inaccurate claims might lead you to seek non-existent applications, while authentic savings remain unclaimed at your regional municipal office. Although I am not a certified financial planner, on this channel every single week I analyze the true economic details that impact older adults directly. Updated regulations, relief options you might already meet requirements for, and actions that yield real benefits. This represents the exact content I publish every week, which you definitely want to catch. If this accurate guidance aligns with what you need, please click subscribe and enable all alerts right away. Now, let's jump right into our main points. We should begin with the crucial clarification. Local real estate assessments are typically set and managed by municipal or county authorities. Your regional district, city government, local township, school board, or designated local tax agency determines your property value, tax rate, special reductions, and grievance procedures. Federal lawmakers can modify how regional real estate payments get handled on standard income returns. However, federal authorities do not pause your local property assessment just because you reach a particular milestone. What specific updates did federal legislators actually implement? For 2026, the nationwide itemized deduction cap, covering state and local payments, is set at $40,400 for standard filers or $20,200 for individuals married filing separately. This cap begins phasing out at elevated modified adjusted gross income benchmarks. Keep in mind, this serves as a federal itemized provision. It will not lower the actual invoice sent by your municipality. It is not limited exclusively to older adults and only offers value if itemizing exceeds your baseline standard allowance. Lawmakers additionally established an extra tax provision for individuals aged 65 and above. Between tax years 2025 and 2028, a qualified individual can claim up to $6,000 or up to $12,000 for married couples if both partners meet the criteria. That specific reduction scales down above designated income boundaries and can be claimed whether you itemize or select standard options. To clarify, this represents genuine federal tax relief, yet it does not constitute a national property tax exemption. This creates two distinct operating frameworks. Federal statutes govern deductions on national tax returns. Meanwhile, regional regulations decide if your residence qualifies for a homestead allowance, senior rate cap, valuation ceiling, payment delay option, circuit breaker credit, rate transfer benefit, or alternative real estate protection. Conflating these distinct systems is precisely where property owners encounter confusion. Let's analyze what your birth decade actually indicates. For people born during the 1940s, your age falls roughly between your late 70s and mid-80s in 2026. Consequently, you easily satisfy the baseline age criteria for almost every initiative starting at 65, 70, or 75. Yet reaching the age threshold alone might not guarantee approval. Numerous programs demand that the residence serves as your primary dwelling, mandate that you hold a valid title interest, set total household income ceilings, or require annual renewal paperwork. Illinois offers a clear demonstration of these rules. Its low-income senior assessment freeze homestead exemption opens at age 65, features an income cap, and demands annual submission. Furthermore, the term freeze frequently gets misunderstood. A program might cap the property's equalized assessed baseline valuation as long as eligibility continues, yet the final invoice total could still increase whenever local tax rates rise or new physical improvements get added. Texas uses an alternative methodology. Property owners reaching age 65 or beyond may secure an extra residential homestead exemption, while local school district portions can be locked under a maximum ceiling. That does not mean every single line item on the overall statement stays permanently locked. Cities, counties, and secondary taxing entities can implement separate rules, and property owners must confirm that accurate documentation remains filed. New York presents another distinct setup. Enhanced STAR delivers expanded school tax relief to qualified homeowners aged 65 or older who satisfy specific income and residency guidelines. Starting in 2026, state authorities streamline the transition process for individuals turning 65. Nevertheless, that remains a state-level adjustment, rather than a universal national law. For an individual born in the 1940s, the priority should not involve searching for a fictitious national senior freeze form. The proper focus is determining which age-linked programs your specific state or county currently maintains, and ensuring every required document and renewal gets fully submitted. Inquire explicitly regarding senior homestead allowances, valuation caps, school property relief, payment deferrals, circuit breaker credits, and specialized options for military veterans, surviving partners, or individuals managing disabilities. Additionally, ask whether approved relief can apply retroactively. Certain jurisdictions permit retroactive adjustments or corrections within a restricted time frame. Others maintain strict exclusions. If your active tax benefit disappeared following a mortgage refinance, title transfer, loss of a spouse, or placing the residence into a trust structure, request a clear written explanation. Updating property ownership records can accidentally interrupt existing relief, even if you continuously meet every age requirement. Homeowners born during the 1950s currently range from their late 60s to mid-70s. By late 2026, every person within this group reaches at least age 67. Therefore, this entire demographic satisfies the widespread age 65 benchmark. The key difference involves many individuals in this group having recently retired, shifted income streams, eliminated mortgage debt, or started drawing Social Security payments. These altered circumstances can impact income-tested property assistance initiatives, even if the market value of your residence remains completely unchanged. This demographic ought to monitor the expanded federal senior deduction closely. If you are 65 or older with income falling within the designated limits, this deduction can lower overall taxable income. It applies regardless of real estate ownership, yet many homeowners overlook it while focusing strictly on municipal property invoices. Simultaneously, evaluate your eligible itemized claims, including qualifying regional real estate taxes, against your base standard deduction. Avoid assuming that a higher state and local tax cap automatically makes itemizing preferable. An additional important detail exists for long-term homeowners planning an eventual sale. Federal regulations permit excluding up to $250,000 in capital gains from selling your primary residence, or up to $500,000 on qualifying joint returns, provided ownership and residency duration requirements get satisfied. No bonus $100,000 gain exclusion exists simply because the seller falls between ages 66 and 75. Your adjusted cost basis, documented property upgrades, periods of business or rental use, and prior tax exclusions will significantly shape the actual calculation. Prior to listing a home, gather your original settlement statement, receipts from major structural updates, and official title documentation. Installing a new roof, adding room additions, completing a major kitchen remodel, or building accessibility features can raise your basis and minimize taxable gains. Standard maintenance usually does not qualify for identical tax treatment. Maintaining accurate historical paperwork often proves far more valuable than any viral senior claim that lacks factual basis. Here is what you should do next. The real savings, rate reductions, and assistance tools most older adults qualify for but frequently miss have been compiled into one clear reference source, organized by state and program category, so you avoid searching confusing municipal websites for hours. It provides simple, direct guidance so any eligible adult can identify programs suited to their situation. Regardless of where you reside, valuable support exists that you might be leaving behind. This tool is titled the Senior Exemption Playbook, located right in the pinned top comment directly beneath this video. Clicking it once provides complete access to all these resource materials. Be sure to keep watching because our next topic covers a critical filing trap capable of canceling an active senior exemption even after proper qualification. Specifically, the strict renewal timelines your local assessor might never directly mention. Property owners born in the 1960s need to separate into two subcategories. Individuals born early in that decade may already be 65 or will reach 65 during 2026. Conversely, individuals born in the later years remain below standard senior thresholds. That does not mean no assistance exists. It simply means searching beyond basic age categories. California provides a clear illustration of this concept. Proposition 19 permits qualifying homeowners aged 55 or older to transfer their baseline taxable valuation to a replacement primary home, subject to specific criteria and submission rules that prove incredibly beneficial when downsizing or moving. However, this remains a state constitutional provision. It does not represent a $5,000 national relocation credit, nor does it apply automatically across other states. Homeowners under 65 can still qualify for general homestead programs, income-based circuit breakers, disability provisions, disabled veteran relief, surviving partner benefits, or local tax deferrals. Certain options start at age 55 or 60, while others carry no age minimum whatsoever. For this age bracket, the mistake lies in waiting until age 65 without exploring existing options today. Exercise caution before changing your primary residence. In numerous locations, a long-held property benefits from capped or limited taxable values. Selling that property to acquire a different home can reset taxable valuations unless specific portability rules apply. Consequently, moving to a smaller house might actually trigger a higher property tax invoice than anticipated. Before finalizing a purchase, request a formal written estimate from the local tax assessor in your target county and inquire whether transferring existing valuation benefits or senior protections requires filing within a strict timeframe. Furthermore, avoid relying on fake online form claims. The IRS does not issue a Form 1098-SR for a nationwide 3% assessment cap. Schedule R serves to calculate federal credits for seniors or individuals with disabilities. It is not a 15% home modification tax credit. Standard Form 1098 simply reports paid mortgage interest, while national home sale rules remain tied strictly to statutory IRS ownership and occupancy requirements. Now let's examine the critical deadline and renewal trap. Numerous property tax protections do not remain active permanently just because you qualified initially. One county might process renewals automatically, whereas another requires yearly income verification. A third jurisdiction might mandate a fresh application following a move, title modification, marriage, divorce, loss of a spouse, trust transfer, or change in occupancy status. Missing an official deadline can delay your relief for an entire tax year. To stay fully protected, follow this reliable routine. Locate your most recent real estate invoice and identify the parcel identification number, assessed valuation, taxable amount, active exemptions, and listed taxing entities. Next, navigate to official state revenue portals, county assessor sites, appraisal district pages, or local tax collector portals. Search using exact terms like senior property tax exemption, over 65, homestead, assessment freeze, tax deferral, and circuit breaker. Steer clear of third-party sites promising federal property grants or charging fees for application forms that government offices provide entirely free. Following that step, contact your local office directly to ask 5 key questions. Which programs apply to my current age? Does an income limit apply? Must I occupy the home on a specific calendar date? Does the benefit apply automatically or require an application? Does it renew automatically or require annual refiling? Afterward, request exact submission deadlines, official form numbers, and written responses via email. Retain complete copies of age verification, personal identification, deed or trust paperwork, occupancy documentation, income records where applicable, disability or veteran verification, and official submission receipts. If submitting online, print the confirmation screen. If mailing documents, select a trackable delivery method. If an exemption request gets denied, review appeal guidelines immediately, as submission windows are often short. Additionally, differentiate an exemption issue from a property valuation issue. An exemption reduces taxable value or final taxes under a specific program, whereas an assessment appeal argues that the official valuation or property classification is incorrect. You might need to address both issues separately. Compare the assessor's physical description of your property against its actual state, checking square footage, structural condition, room count, land size, and comparable area sales. A senior exemption will not resolve a factual mistake in your property assessment record. Let's summarize everything clearly. If you were born in the 1940s, you meet most age thresholds, but you must still confirm income limits, annual renewal rules, and whether a freeze caps assessed values or final invoices. If you were born in the 1950s, evaluate both local age 65 property tax programs and valid federal updates, including the temporary senior deduction and higher state tax deduction limits when itemizing proves beneficial. If you were born in the 1960s, do not assume you must wait. Older individuals in this group may now reach age 65, while others might qualify through age 55 rules, portability benefits, disability options, veteran programs, income-based relief, or standard homestead provisions. The takeaway is not that federal lawmakers mandated universal property tax calculations based on birth decade. They did not. The true story is that federal officials updated national tax deductions while state and local governments maintained complete control over exemptions, freezes, caps, deferrals, and filing deadlines that directly determine your local property tax bill. Your next steps are simple. Confirm federal deduction guidelines for your income tax return, then verify local property tax options connected to your specific real estate parcel. Rely exclusively on official forms, secure written confirmation, and record all renewal deadlines on your calendar. That is the reliable way to turn your age, income, and homeownership status into genuine economic savings rather than unverified headlines. Be sure to subscribe and enable notifications, because every week I break down the real financial regulations affecting seniors, the underlying documentation, and the critical deadlines that could cost you money if overlooked.